America is a nation built on water. For centuries, our rivers carried commerce, our lakes hosted family summers, and our oceans connected us to the world. Boating wasn't just recreation, it was identity. It was freedom. It was the American dream, wrapped in fiberglass and marine-grade aluminum, powered by engines that promised escape from the everyday grind. But in 2026, something fundamental has shifted in the waters. Walk into any marina, from Seattle to Savannah, and you'll see it immediately. Row after row of vessels with for sale signs hanging from their bows. Scroll through any online marketplace, and the listings go on for pages. Boats that cost $70,000 3 years ago are now listed at $49,000, then $45,000, then $39,000, as sellers desperately undercut each other in a race to the bottom. The pandemic created a boating boom unlike anything the industry had ever seen. But booms don't last forever, and when they end, the reckoning is swift and merciless. Here's what most people missed while they were celebrating record sales and waiting lists that stretched for months. All those boats had to go somewhere. All those first-time buyers who purchased during the frenzy had to face the reality of ownership costs, maintenance schedules, and dock fees. All those dealers who ordered massive inventory based on unsustainable demand now sit on millions of dollars worth of vessels they cannot move. The used boat market, valued at roughly $9 billion annually, has transformed from a steady secondary market into the primary battlefield, where the future of American recreational boating will be decided. And that's where the story truly begins. To understand how we arrived at this moment, you need to understand what boating has meant to America for generations. This isn't just about recreational toys for the wealthy. The marine industry employs hundreds of thousands of Americans across every coastal state and many inland ones. Boat builders in Florida, Wisconsin, and Minnesota, fiberglass workers and marine technicians, marina operators and dock hands, sales staff and finance specialists, parts manufacturers and engine assemblers. These jobs built communities. They sustained families. They were passed down like heirlooms, with fathers teaching sons the craft of laying up hulls or rigging electrical systems on sport fishing boats. The industry generated billions in economic activity, supporting everything from trailer manufacturers to marine insurance companies to the restaurants and hotels in boating destinations. Boating represented something deeper than economics, though. It was the embodiment of American freedom, the ability to cast off the dock lines and head wherever the water would take you. Whether it was a 14-foot aluminum fishing boat on a quiet lake or a 40-foot offshore sport fisher chasing marlin in the Gulf Stream, boat ownership meant autonomy, adventure, and connection to nature that no other activity could replicate. The industry understood this emotional component and marketed accordingly. Advertisements didn't sell boats. They sold lifestyle, family memories, and the promise of weekends that felt like vacations. For decades, this formula worked brilliantly. The market was stable, predictable, and profitable. Manufacturers like Brunswick Corporation, which owns brands including Sea Ray, Boston Whaler, and Bayliner, could forecast demand with reasonable accuracy. Dealers maintained steady inventory. Buyers financed purchases over reasonable terms and kept their boats for years before trading up. The used market functioned as a healthy secondary channel, where older boats found new owners who couldn't afford new models. Marine lenders like Trident Funding and Essex Credit understood the collateral and wrote loans accordingly. Marinas maintained waiting lists for slips in desirable locations. The ecosystem was balanced, but ecosystems are fragile things, and in early 2020, everything changed. When the pandemic arrived in March of 2020, nobody predicted what would happen to recreational boating. The initial assumption was disaster. With the economy shutting down and unemployment spiking, luxury purchases like boats should have collapsed. But the opposite occurred. Americans stuck at home, unable to travel internationally, unable to visit crowded entertainment venues, unable to live their normal lives, began looking for outdoor recreation that allowed social distancing. Boating was perfect. You could take your family out on the water, away from crowds, enjoying sunshine and fresh air while maintaining complete isolation from others. Suddenly, everyone wanted a boat. Dealerships that had been quiet for weeks were overwhelmed with buyers. Manufacturers that had reduced production ramped back up as fast as possible. Used boats that had been sitting on the market for months sold within days. Prices began climbing, not slowly or incrementally, but dramatically and quickly. A pontoon boat that cost $30,000 in February was $40,000 by June and $45,000 by September. Personal watercraft that typically depreciated steadily were selling used for more than new retail prices because you could take delivery immediately instead of waiting months for factory production. The industry had never experienced anything like it. Waiting lists for new boats stretched into 2021, then 2022. Buyers paid deposits on boats they wouldn't receive for 18 months. Dealers marked up prices above manufacturer, suggested retail because they could. Marine lenders loosened credit standards to accommodate the flood of first-time buyers who had never owned a boat but suddenly couldn't imagine life without one. Interest rates were historically low, making financing easy and payments manageable. The stock market was soaring, cryptocurrency was minting millionaires, and home values were skyrocketing. Americans felt wealthy, and they spent accordingly. Manufacturers responded by ramping up production capacity. Brunswick expanded facilities. Newer companies like Barletta Pontoons invested in additional manufacturing space. The entire supply chain, from resin suppliers to upholstery manufacturers to marine electronics companies, went into overdrive. This wasn't just growth, it was a frenzy, a gold rush mentality that assumed the good times would continue indefinitely. By 2021, the boom was in full swing, and the industry was celebrating. The National Marine Manufacturers Association reported record sales. Trade shows were packed. Boat shows in Miami, Fort Lauderdale, and Minneapolis drew massive crowds. Consumer confidence in the boating market was at all-time highs, but beneath the champagne toasts and congratulatory press releases, problems were developing. The first was supply chain disruption. The same pandemic that created demand was strangling supply. Semiconductor chips needed for electronic systems were scarce. Resin and fiberglass became difficult to source. Upholstery materials faced delays. Engines were back-ordered. A boat might be 90% complete, but couldn't ship because it was missing a critical component. Manufacturers pushed deliveries back repeatedly, frustrating buyers who had paid deposits and were making loan payments on boats they couldn't use. The second problem was cost inflation. Everything got more expensive. Raw materials, labor, shipping, overhead. Manufacturers had no choice but to raise prices, and they did so aggressively. A boat that was listed at $60,000 in 2020 was $75,000 in 2021 and $85,000 in 2022 for essentially the same product. Buyers grumbled but paid because alternatives didn't exist. If you wanted a boat, you accepted the new reality. The third problem was the buyer profile. Many of the people purchasing boats during the pandemic had never owned one before. They didn't understand maintenance costs, winterization requirements, or the reality that a boat depreciates the moment you take delivery. They didn't factor in dock fees that could run $3,000 to $10,000 annually. They didn't consider fuel costs that could hit $200 for a single day on the water with a larger boat. They didn't anticipate insurance premiums that climbed every year. They bought based on emotion and the availability of cheap financing, not rational calculation of total ownership costs. And critically, many financed the purchase with little money down, taking 7 or 10-year loans on depreciating assets. This created a debt bomb that would explode when circumstances changed. The fourth problem was inventory buildup. Manufacturers, seeing unprecedented demand, assumed it would continue and built accordingly. Dealers ordered aggressively, not wanting to miss sales opportunities. By late 2022, production capacity that had taken 2 years to expand was finally coming online just as the market was beginning to shift. Nobody noticed at first, because there was still pent-up demand from buyers who had been waiting. But the pipeline was filling with boats that would soon have nowhere to go. Then, the Federal Reserve began raising interest rates. In March of 2022, the federal funds rate stood near zero, where it had been throughout the pandemic. By July of 2023, it had climbed above 5%, the fastest rate hiking cycle in decades. The goal was fighting inflation, but the consequence was making borrowing expensive. Suddenly, financing a $40,000 boat meant monthly payments that were hundreds of dollars higher than they would have been a year earlier. Buyers who were on the fence decided to wait. Buyers who were stretching their budget decided they couldn't afford it. The market began cooling. Sales that had been immediate and effortless started taking longer. Boats sat on showroom floors for weeks instead of days. Trade show leads didn't convert as readily. and the used market, which had been red-hot, began softening. Used boats that had appreciated during the pandemic started depreciating again, which is what boats are supposed to do. But this created a problem for owners who had paid inflated prices in 2021. If you paid $55,000 for a used boat that was worth $40,000 pre-pandemic, and now it's worth $42,000, you haven't just lost the premium. You're underwater on your loan. You owe more than the boat is worth. This became increasingly common as 2023 progressed. Owners who wanted to sell discovered they couldn't get enough to pay off their loans. They were trapped. Some decided to keep the boat and ride it out. Others, facing financial pressure from other sources, had no choice but to sell at a loss and write a check at closing to cover the difference. The most financially stressed simply stopped making payments, and repossessions began climbing. Marine lenders found themselves owning boats they didn't want in a market that was softening. They needed to liquidate quickly, which meant discounting aggressively. These repossessed boats flooded auction sites and dealer lots, adding to inventory and putting downward pressure on prices across the board. By 2024, the slowdown was undeniable. Manufacturers reported sales declines. Dealers complained about inventory that wasn't moving. But the industry convinced itself this was a temporary correction, a return to normal after an unsustainable boom. They expected stabilization. Instead, things got worse. The problem was structural, not cyclical. Too much production capacity chasing too few buyers. Too much debt in the system from buyers who couldn't afford what they'd purchased. Too many boats, both new and used, competing for too few dollars. The underwater boat loan problem became acute. Estimates suggested that a significant percentage of boats financed in 2021 and 2022 were worth less than the outstanding loan balance. Owners couldn't trade up even if they wanted to because dealers wouldn't accept the negative equity. This froze the normal churn that keeps the market healthy. In a functioning market, owners trade boats every 5 to 7 years, selling or trading their current boat and buying something different. But when you're underwater, trading means writing a check for thousands of dollars just for the privilege of taking on more debt. Most people won't do that, so they keep the boat or they default. Either way, new inventory doesn't move. Dealers felt the squeeze from both sides. They had new inventory they couldn't sell because buyers were choosing used boats or waiting for better prices. And they had trade-ins they accepted at values that no longer made sense, sitting on their lots, depreciating daily. Operating expenses, property taxes, insurance, and payroll continued regardless of sales. Lines of credit used to finance inventory were expensive now that interest rates were high. Smaller dealers began closing. Family operations that had lasted decades couldn't survive the combination of slow sales and high carrying costs. Consolidation accelerated as larger dealer groups absorbed failing competitors at fire sale prices. Manufacturers faced their own crisis. Production facilities that had been expanded couldn't be shut down without massive costs. Laying off skilled workers meant losing that expertise forever. But continuing to build boats that dealers couldn't sell was equally destructive. Several mid-sized manufacturers quietly filed for bankruptcy protection. Iconic brands that had built boats for generations were sold to private equity firms who had no emotional attachment to legacy or craftsmanship. The only question was profitability. 2025 brought the reckoning everyone had feared. New boat sales fell nearly 9% year over year, a stunning decline that shocked even pessimists. Some categories declined more. Larger cruising boats, already expensive, saw double-digit percentage drops as buyers balked at six-figure purchases during economic uncertainty. Sport fishing boats, which can easily exceed $200,000 for well-equipped models, sat unsold. Dealers who had ordered inventory 18 months earlier based on boom time assumptions now owned boats nobody wanted at prices nobody would pay. Discounting became aggressive. 20% off became 30% off. Manufacturer incentives piled on. 0% financing for qualified buyers. Dealer cash to move aged inventory. It wasn't enough. The calculus had changed. A buyer looking at a new 30-foot center console boat priced at $90,000 with a 20% discount could find a 3-year-old example of the same model for $55,000. Yes, the used boat had some hours on the engines and the upholstery showed wear, but saving $35,000 covered a lot of maintenance. And that's if the new boat discount was real. Many dealers were cutting prices on paper while protecting margins with hidden fees, documentation charges, and mandatory dealer-installed accessories. Buyers, increasingly sophisticated and able to research prices instantly online, weren't fooled. They walked away and bought used. The used market, meanwhile, became a feeding frenzy. Private sellers listed boats on websites like Boat Trader, Facebook Marketplace, and Craigslist. Dealers listed trade-ins and repossessions. Auction companies held weekly sales of lender-owned inventory. The listings multiplied weekly, thousands of boats, tens of thousands. A buyer could spend days scrolling through options, watching prices drop in real time as sellers competed. A boat listed Monday at $38,000 was $35,000 by Friday. The following week, it was $32,000. Sellers weren't playing games. They needed out. Dock fees were due, loan payments were crushing, storage costs were mounting. Many owners had realized that boating wasn't what they thought it would be. The maintenance was constant. The cost was oppressive. The actual usage was minimal. They'd take their families out 3 or 4 times the first season, twice the second season, and never the third. The boat sat, depreciating, costing money, generating guilt. Selling, even at a loss, brought relief. This created a vicious cycle that defined 2025 and has intensified into 2026. More boats for sale means more competition, means lower prices, means more owners. Going underwater means more defaults, means more repossessions, means even more inventory, means prices fall further. It's a spiral with no natural bottom except total capitulation, where boats are priced so low that they become attractive to new buyers who weren't previously in the market. We might be approaching that point now. Prices have fallen substantially from their 2021 peaks. Categories vary, but overall, the used market has given back much of the pandemic appreciation. A pontoon boat that sold for $50,000 used in 2022 is now mid-30s. A personal watercraft that commanded $15,000 is now under 10. A center console that was $80,000 is now in the low 60s. This represents real value for buyers with cash or good credit, but it's devastating for anyone who financed at the peak. Those buyers have lost tens of thousands in equity, money that simply evaporated as the market corrected. The psychological impact extends beyond individual finances. It destroys confidence in boats as assets. Previous generations viewed a boat as something you kept for years, used heavily, and eventually sold to fund the next one. You expected depreciation, but you also expected years of utility and memories that justified the cost. Today's buyers watch their friends and neighbors lose fortunes on boats purchased just 3 years ago. That creates hesitation that persists even when prices become attractive. Why buy now when prices might fall further? Why commit to ownership costs when I could rent? Why tie up capital in a depreciating asset? These questions paralyze potential buyers, which extends the downturn. Meanwhile, dealers face existential threats. Unlike manufacturers who can slow production, dealers have fixed costs that don't flex with sales. The lot still needs insurance. The building still needs utilities. The staff still needs paychecks, even reduced staff. And the inventory still needs financing. Floor plan lines of credit charge interest monthly on unsold inventory. Every boat that sits for 90 days costs thousands in carrying charges alone. After 6 months, a boat that was marginally profitable becomes a guaranteed loss. Dealers are forced to choose between holding inventory, hoping for better markets, and cutting prices to liquidate and stop the bleeding. Most are choosing liquidation. This puts them in direct competition with private sellers who have no overhead and can undercut dealer prices easily. The democratization of boat selling through online platforms has fundamentally shifted market dynamics. 20 years ago, selling a boat privately meant classified ads in local newspapers and physically showing the boat to potential buyers. It was time-consuming and limited to local markets. Today, a seller can photograph their boat, write a description, and list it on Boat Trader, reaching millions of potential buyers nationwide within an hour. They can price it aggressively because they have no dealer overhead to cover. They can negotiate directly with buyers, closing deals in parking lots and marina offices without sales commissions. The transparency of this marketplace benefits buyers enormously but destroys dealer margins. Why pay dealer markup when you can buy the same boat from the original owner for 20% less? Dealers respond that they offer warranties, financing, and service, but many buyers don't value these enough to justify the premium. They'll take the risk on a private sale to save substantial money. This disintermediation mirrors what happened to car dealers, travel agents, and retail stores when the internet enabled direct consumer-to-consumer transactions. The marine industry is simply catching up. The roughly $9 billion annual used boat market is increasingly consumer-to-consumer rather than dealer-mediated. This keeps prices lower for buyers, but makes survival harder for dealers who need margin to cover costs. The result is industry consolidation as smaller operations fail and larger dealer groups absorb their market share. This isn't necessarily bad for consumers who benefit from the scale and resources of larger operations, but it represents the death of family businesses that defined marine retail for generations. These weren't just commercial enterprises. They were community institutions, places where local boaters gathered, where knowledge was shared, where relationships were built over decades. Their disappearance represents cultural loss that transcends economics. The manufacturers, watching sales collapse and dealer networks struggle, face impossible choices. Do they continue producing boats and force dealers to take inventory, risking dealer bankruptcies that destroy distribution networks? Or do they slash production, laying off workers and accepting underutilized facilities? Most have chosen a middle path, reduced production with incentives to move existing inventory. But this doesn't solve the fundamental problem of too many boats chasing too few buyers. Some manufacturers have pivoted toward innovation, developing electric propulsion systems, hybrid powertrains, and smart boat technology with integrated navigation and monitoring. The theory is that technology will justify premium prices and attract buyers who want the latest features. Early results are mixed. Yes, some affluent buyers appreciate electric outboards from companies like Pure Watercraft or Vision Marine Technologies that offer silent operation and zero emissions. But most buyers prioritize cost over innovation, especially in a declining market. Electric propulsion is expensive, range is limited, and charging infrastructure at marinas is sparse. For most buyers, traditional gasoline engines remain the practical choice, and they'd rather buy used with proven technology than new with experimental systems they don't fully trust. The industry hoped that younger buyers, supposedly more environmentally conscious and tech-savvy, would drive demand for these innovations. Instead, younger Americans are buying fewer boats overall. Millennial and Gen Z consumers, burdened by student debt, expensive housing, and uncertain economic prospects, view boats as unaffordable luxuries. They'd rather spend money on experiences like travel than ownership commitments like boats that require storage, maintenance, and insurance. When they do want time on the water, they rent through services like BoatSetter or Get My Boat, rather than buying. This peer-to-peer rental model, similar to Airbnb for accommodations, allows boat owners to offset costs by renting to others when they're not using their vessel. It's convenient for renters and helpful for owners, but it further reduces new boat sales. Why own when you can rent exactly what you need, when you need it, without the burden of ownership? As we move deeper into 2026, the market remains in flux. Inventory levels are extraordinarily high. Prices continue falling in most categories. Dealer consolidation continues. Repossessions keep adding supply. But there are signs that we may be approaching a bottom. Sales volumes have stabilized at lower levels. Buyers who have been waiting are starting to recognize that values are genuinely compelling. A well-maintained used boat at 50% of its 2021 price represents real value, regardless of whether prices fall another 5 or 10%. At some point, value overcomes fear, and buyers return. We may be reaching that inflection point. Additionally, the boats that were purchased during the pandemic boom are aging. A boat from 2020 is now 6 years old, approaching the point where significant maintenance becomes necessary. Engines need service, upholstery needs replacement, electronics need updating. For many owners, this creates the decision point to either invest in renewal or sell and move on. Those who sell add to current inventory, but once this cohort moves through the system, supply will normalize. The industry will stabilize at a new equilibrium, likely with fewer dealers, lower prices, and more realistic expectations about sustainable demand. Manufacturers who survive will be leaner and more conservative about production planning. Dealers who remain will focus on service and relationships rather than pushing new inventory. Buyers will approach boat ownership with clearer understanding of costs and commitment required. This isn't the death of American boating. It's a painful reset after an unsustainable boom created distortions that required correction. Similar cycles have occurred in housing, automobiles, and other asset markets. They're disruptive and destroy wealth for those caught on the wrong side, but they eventually clear and create foundations for healthier growth. The question is how long the correction takes and how much damage occurs before recovery begins. For marine industry workers, this period has been devastating. Technicians, sales staff, dock workers, and support personnel have lost jobs as dealers closed and manufacturers downsized. These weren't abstract economic adjustments. They were families losing income, health insurance, and identity. Skills developed over decades became less valuable as demand evaporated. Some workers transitioned to other industries, but many, especially older workers, deeply invested in marine trades, found themselves unemployed or underemployed in jobs that didn't utilize their expertise or pay comparable wages. The social cost of industry contraction rarely appears in economic analyses, but it's real and persistent. Communities built around marine manufacturing and sales, places like Fort Lauderdale, Florida, or Osceola, Wisconsin, felt the impact across entire local economies. When the boat plant lays off 200 workers, the ripple effects hit restaurants, grocery stores, gas stations, and every other business those workers patronized. Property tax revenues decline as business values fall. Municipal budgets face pressure. Services get cut. The decline cascades through everything. These communities are resilient and will recover, but the transition is painful and the scars long-lasting. For boat owners caught in the downturn, the experience has been equally difficult. Many financed boats believing they were making reasonable purchases only to discover they were buying at the peak. Watching equity evaporate, receiving loan statements showing balances higher than current market values, facing impossible choices between continuing payments on underwater assets or defaulting and destroying credit has been financially and emotionally crushing. These weren't reckless speculators. They were families trying to enjoy boating, misled by extraordinary market conditions into believing inflated prices were normal. The industry, from manufacturers to dealers to lenders, enabled this by treating the boom as sustainable rather than exceptional. Everyone profited during the run-up, but owners bore most of the loss during the decline. This creates justified anger toward an industry that seemed more interested in moving inventory than ensuring buyers made sound decisions. Looking forward, the used boat market will continue dominating in 2026 and likely beyond. The inventory overhang is too large to clear quickly. Prices will remain under pressure until supply and demand reach equilibrium. This could take another year or more, depending on economic conditions, interest rates, and consumer confidence. If the broader economy remains stable and interest rates decline, buyers may return sooner. If recession arrives or rates stay elevated, the correction extends. One certainty is that the industry emerging from this period will look different. Fewer dealers, more online sales, greater price transparency, lower margins, and more realistic expectations about demand sustainability. Innovation will focus on value rather than features, with manufacturers offering simpler, more affordable models that appeal to budget-conscious buyers rather than loaded premium boats that sit unsold. The market will also likely see increased segmentation, with clear differentiation between entry-level boats for occasional users and premium models for serious enthusiasts willing to pay for quality and performance. The middle market, where margins were never strong, may largely disappear as buyers choose either cheap or expensive, but avoid mediocre. This mirrors trends in other consumer markets, from airlines to retail, where the middle has been hollowed out. For buyers, this environment represents opportunity. Prices are low, selection is vast, and sellers are motivated. If you've considered boat ownership but been deterred by cost, now is objectively a good time to buy. But approach with realistic expectations. Understand total ownership costs, including storage, insurance, maintenance, and depreciation. Buy only what you'll actually use. Favor reliable brands with strong dealer networks for parts and service. Consider starting with an affordable used boat to determine if boating fits your lifestyle before committing to something expensive. And recognize that boats are expenses, not investments. They will depreciate. The goal is maximizing utility and enjoyment per dollar spent, not financial return. If you accept those realities, boat ownership can be deeply rewarding. If you expect something different, you'll join the legions of disappointed sellers currently flooding the market. The story of the 2026 used boat market is ultimately a story about human behavior, economic cycles, and the gap between expectation and reality. Americans wanted to believe the pandemic boom would last, that prices would keep rising, that demand was permanently elevated. The industry wanted to believe it too, and acted accordingly. But markets always revert to mean. Unsustainable trends always correct. The only questions are when and how painful the process will be. For recreational boating, the correction has been severe but not fatal. The industry will survive, though different in structure and scale. The water remains. The desire for freedom and adventure remains. The appeal of being on a boat with family or friends, away from screens and stress, remains. These fundamentals haven't changed. What changed was the financial speculation and irrational exuberance that treated boats like investments rather than recreational tools. As that mentality gets washed away by market reality, what's left is more honest and sustainable. People who buy boats because they want to use them, not because they expect appreciation. Dealers who focus on service and relationships, not pushy sales tactics. Manufacturers who build for long-term reliability, not quarterly earnings. This is healthier, even if the transition has been painful. The industry needed this reset, however much it hurt. It forced recognition that the pandemic boom was extraordinary and temporary, not the new normal. It reminded everyone that boats are depreciating assets requiring realistic financial planning. It demonstrated that markets punish excess eventually, regardless of how long the parties seem to last. These lessons are valuable, though expensive. The question now is whether they'll be remembered when the next boom arrives, or whether human nature will repeat the same mistakes. History suggests the latter. But for now, the market is correcting, prices are falling, and buyers have opportunity. The water is still there. The boats are still there. The dream of freedom is still there. The question is, who will be left to pursue it, and whether they've learned from the mistakes of those who came before. Do you own a boat? Have you felt the impact of this market correction? Are you watching prices fall and wondering whether to buy, sell, or hold? The decisions being made right now by millions of boat owners, dealers, and potential buyers will shape the marine industry for the next decade. This isn't just about boats. It's about how Americans approach recreation, risk, and financial decisions. It's about communities built around water and the jobs that depend on healthy marine markets. It's about the gap between what we're told and what we experience, between marketing promises and ownership reality. Share your perspective in the comments below. Let's have an honest conversation about where the boat market goes from here and what it means for everyone who loves being on the water. And if you value deep, honest stories about America's maritime world, subscribe for more boat industry documentaries and breaking marine news. Because the story isn't over, the correction continues, and understanding what's really happening matters more than ever.